and welcome to November 2024 edition of Macro and Market Wrap-Up. Global equity markets rallied on the after effects of Fed rate cut and positive corporate earnings data in the US. Led by the US, DM equities have done better this year so far, with MSCI World up 18% year to date. MSCI Emerging Markets has also caught up in recent months to deliver 12% gains year to date. Chinese stimulus has driven the rally in EM equities, though FIIs pulled the money out of India, driving negative returns in Indian equities in October. There is still a significant room for EM equities and commodities to catch up versus developed market equities when looked at from the longer term perspective. On the other hand, developed market bonds worsened again. The yield on 10-year US Treasury has jumped by 60 basis points since mid-September, and this time the slump in bond prices has gone global, setting international developed market bonds up for a fourth consecutive year of negative or weak total returns. China appears serious about stimulating their economy. We have heard one or the other measures through most days of October. New details suggest that a sum of about RMB 3 trillion should be deployed to mostly shore up the balance sheets of local authorities and banks. It is also becoming clear that the reflation effort will not include large-scale transfers to households. Thus, any boost to consumption will depend on wealth effects through higher asset prices or a stronger labor market helping to boost incomes. The latest economic indicators for September in China finally beat expectations after a long series of misses. In terms of timing, support from the fiscal package will take several months to generate a material economic turnaround. Market movements may be swifter though. The underlying arguments for a recession are much weaker now because central banks all over the world are cutting interest rates and will most likely continue to ease, regardless of inflation. Interest rate cuts are typically reflationary in nature. The US fiscal is likely to stay in expansionary mode, as gauged from the presidential campaign. Hence, attraction of developed market bonds reduces again. To add, China looks to be embracing a more concerted fiscal stimulus, as just discussed. So, the global macro backdrop has once again switched to a reflationary risk rather than a deflationary one. Such backdrops warrant ownership of inflation hedges like gold, energy, commodities, and a much more limited exposure to developed market government bonds in global parlance. Typically, such a backdrop is also favorable for EM equities. Indian equity markets corrected in October. The extent of fall was similar across the market cap. FIIs pulling out of India is impacting large cap in the same breath, even as the valuation arguments are relatively in the favor of large cap over mid and small cap. For India, a sustained and broad-based performance of emerging markets may imply some near-term realignment in the flows towards other EMs. This is because India has been the only major emerging market so far post-COVID that had continued to outperform amidst a relatively challenging phase for the emerging market in general. This in turn has led to the valuation premium for the Indian equities versus the EM equity index swell to a historic high. We may see some moderation in this premium if other EMs start to perform as well. From a longer term perspective, however, an environment of EM outperformance should augur well for India too. Not only will a broad-based global growth have a domestic positive rub-off on domestic growth, but a revival in investor interest in EM equities as an asset class will help from a flow standpoint too. As feared, we have also seen deeper cuts to FY25 earnings estimate in the recent months as commodity price tailwinds abate and revenue growth stays anemic. Economic activity had moderated in first half FY25 in India, but going forward, we expect economic momentum to improve as fiscal spending rises and hence earnings expectation stabilizes. This mix, we believe, is ideal for a reduction in thus far unabated speculative action in the equity markets. We remain of the view that increasingly the market will become more discerning and move back towards companies which have a strong business model, long-term earnings growth visibility, and a sustainable cash flow. The rupee hasn't been depreciating sharply in recent weeks as is made out to be. In absolute terms, the rupee has crossed 84 to the dollar this month, reaching an all-time low. This, of course, is factually true. But the bigger story is how remarkably stable rupee has been in recent months. It is down less than 1% against the US dollar over past year. Even on a 2-year basis, the depreciation is less than 2% against the US dollar, while typical trend has been for rupee to depreciate 3 to 4% annually. Further, what has gone unnoticed is that rupee has remained extremely stable on the real effective exchange rate basis. We have always advocated for rupee to average at 84 against US dollar in FY25, and we continue to hold that thesis. In its recent monetary policy meeting in October 2024, the RBI decided to keep the policy rate unchanged at 6.5%, while shifting its stance from withdrawal of accommodation to a neutral position. This is seen as a signal that RBI is opening the door to potential rate cuts in the near future. Market was speculating about a possible rate reduction in the December or February policy, but this enthusiasm has been tempered by two subsequent developments. First was the release of September CPI. Second was Governor Das' hawkish remarks at Bloomberg's India Credit Forum. RBI is data dependent, and the change of facts could change the opinion. Hence, delving a bit deeper on the recent growth inflation trends warrant merit. One of the key factors influencing the RBI stance is the recent inflation data. September CPI registered 5.5% year-on-year rise, surpassing 5.1 to 5.2% expectation. That said, analyzing recent inflation trends reveals a more benign outlook. Retail inflation averaged 4.6% in the first half of FY25. A higher than 4% RBI target was primarily driven by vegetable prices. Excluding this volatile category, inflation drops to 3 to 3.5% range. Moreover, core CPI has been consistent at around 3.4%. Finally, 60% of the CPI basket reports inflation below 4%. This suggests a lack of significant price pressures across most sectors of the economy, indicating that the monetary policy does not necessarily need to be as restrictive. Further, the government still plays a crucial role in stimulating growth. Growth still needs a policy support in India. The Q2 FY25 GDP print would be critical to shape the monetary policy discourse. We suspect that the growth would underwhelm RBI's expectation, perhaps driving a reassessment of growth inflation conundrum in India by the MPC members. Given that peak policy rate in the current hiking cycle had been significantly below the previous peaks, one anyways expect a very shallow rate cutting cycle this time around. We suspect February or April policies are more likely time periods for a discussion on rate cuts. As industrial credit offtake begins to pick up, the RBI may need to consider other measures to ensure adequate liquidity within the banking system rather than relying solely on interest rate adjustments. Irrespective of the timings, the direction of monetary policy is clear and well poised towards some softening in rates. Markets often anticipate actions ahead of time, and unless there is a significant shift in expectation, we expect bond yield pricing to continue reflecting this cycle of cuts. The demand versus supply dynamic for government bonds is favorable. From a valuation standpoint too, Indian bonds appear neutral to marginally attractive compared to the equity market and their own historical performance during the rate cutting cycle. The corporate bond curve is inverted given pressures from banks' credit to deposit ratio at the front end. This yields a good carry in the short term segment while focusing on building duration via government bonds. Signing off for this month. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.